The rules of wealth have shifted. While retail investors worry over shifting interest rates and lingering inflation, the global 1% moved trillions into alternative frameworks that bypass traditional banking. If your portfolio looks the same as it did in 2023, you're already behind. Welcome to the 2026 wealth transfer. The financial landscape has evolved into a hybrid of private markets, artificial intelligence infrastructure, and borderless tax strategies. We aren't waiting for the macroeconomic dust to settle. The dust has settled, and the new plan is formed on an entirely different scale. According to recent data from global banks and researchers, the ultra-wealthy don't chase simple stock market returns. They buy jurisdictional security, become their own banks through private credit, and leverage digital nomadic tax codes to keep what they earn. Market data reveals that near consensus among advisors points to deep customization for high-net-worth portfolios, reflecting a departure from standard index investing. The gap between mass-market advice and institutional reality has never been wider. Financial advisors still tell the middle class to buy broad index funds and wait 40 years. Meanwhile, the top echelon engineers sophisticated vehicles to generate cash flow today while protecting capital from systemic shocks. In this breakdown, we decode 4 specific blueprints the elite use to insulate and multiply their wealth. We explore the notable pivot to private credit, the geographic allocation of assets, the rebirth of commercial real estate through specialized infrastructure, and the tokenization of hard assets. We examine the precise mechanics of modern wealth defense and growth. Prepare to recalibrate your entire approach to investing. What if you could step in front of the bank, gain their profit margins, and lend capital to massive corporations? This is the reality of private credit in 2026. For decades, when a mid-sized company needed cash, they went to a strict, regulated bank. But post-2024 regulations altered traditional lenders, prompting them to retreat from the commercial lending space. The elite stepped into the void. According to leading 2026 alternative investments outlooks, the private credit market has expanded to a remarkable $2.5 trillion. High-net-worth individuals move massive allocations away from volatile public stocks and into direct lending. To understand the mechanics, we must translate this into a real-world scenario. Imagine you and a group of modern investors pool together $10 million. A thriving tech company needs capital to expand its data centers, but decides to skip over sluggish banking bureaucracy. You loan them the money at a 10% interest rate, secured against their hard assets. If they default, you own their data centers. If they pay, you collect consistent, high-yield cash flow that beats inflation. You're no longer hoping a stock chart trends upward. You're generating contractually obligated income. In 2026, the elite lock in these high single-digit and double-digit yields, utilizing semi-liquid vehicles that bring private credit to the individual investor without locking capital away. This asset class provides strong insulation from public market volatility. Private loans don't trade on a public ticker. They don't drop because a chief executive officer posts a controversial message online. They compound in silence in the background. Institutions and family offices prioritize asset-backed lending, where the debt ties to physical collateral like commercial real estate or specialized machinery. By replacing the bank, investors capture the spread that financial institutions used to keep for themselves. It's a foundational shift in how capital flows through the economy, rewarding those who provide liquidity with robust, risk-adjusted returns. Earning a massive income is lessened if your home country collects half of it to fund sovereign debts you didn't create. The 2026 Global Asset Wealth Report highlights a crucial evolution. The ultra-wealthy adopt a highly mobile lifestyle. They don't just buy luxury real estate for yield. They purchase jurisdictional security, But this strategy isn't restricted to billionaires with private jets. Digital nomads and modern remote investors execute the exact same playbook through geo-arbitrage and international tax optimization. Imagine making 100Ks in Dubai. Because the United Arab Emirates has zero personal income tax, you keep all 100K. Now contrast that with earning the exact same amount in New York or California, where federal, state, and local taxes take 40% of your labor. The mathematical difference over a decade is notable. For American citizens, the Foreign Earned Income Exclusion, or FEIE, is the ultimate wealth preservation tool. If you spend at least 330 days outside the United States in a 12-month period, the Internal Revenue Service allows you to exclude over $120,000 of your earned income from federal income tax. You earn strong dollars, spend in a weaker currency to maximize your purchasing power, and legally bypass the heaviest tax burdens. The top 1% treat their citizenship and residency as flexible assets. They establish tax residencies in business-friendly hubs like Singapore or the UAE, routing their investments through jurisdictions that protect capital rather than diminish it. Industry research shows the global wealthy move their investable assets based on international mobility and tax optimization strategies. Wealth management in 2026 requires geographical allocation over simple asset allocation. High net worth investors secure second passports and golden visas, ensuring that no single government possesses absolute authority over their financial destiny. This level of diversification protects against localized political instability, shifting tax regimes, and economic stagnation in traditional Western markets. Traditional office spaces are faded, but the buildings of the future generate returns that outpace the broader stock market. Real estate faced a major adjustment over the last few years. The borrowing costs created a slow pause in transaction volumes, but 2026 marks the absolute inflection point. Major financial market outlook confirms that lower interest rates and motivated sellers drive a steady recovery in both transaction activity and asset valuations. Current analysis reports that falling interest rates should drive global real estate investment turnover past $1 trillion in 2026, the highest level since 2022. However, the top tier of investors decline to buy generic suburban strip malls or outdated downtown office buildings. They target specialized sectors, multifamily residential complexes, life sciences real estate, and artificial intelligence-driven infrastructure. Let's translate the concept of REITs, or real estate investment trusts, into a modern context. Imagine a sprawling, hyper-cooled warehouse sitting just outside a major metropolitan hub. It doesn't house retail goods. It houses thousands of high-performance servers powering the artificial intelligence systems of the world. Building and cooling this data center costs hundreds of millions of dollars. A solo investor can't afford it, but through a specialized infrastructure REIT, you buy shares of the corporate entity that owns that specific data center. You collect a portion of the rent paid by the global tech giants leasing that space. This is a backdoor move on the artificial intelligence boom. Instead of guessing which software company will emerge successful, you own the physical concrete, the cooling systems, and the power lines they all need. Furthermore, the residential housing market experiences a strong lock-in effect. Everyday homeowners decline to sell their properties because they hold old, low-rate mortgages from years past. This dynamic creates a notable housing shortage, driving millions of potential buyers into the rental market and filling multi-family apartment complexes. The wealthy pool capital to acquire these multifamily assets at strategic discounts, riding the wave of guaranteed tenant demand and the accelerating rent growth predicted for the remainder of the decade. Real estate in 2026 requires careful precision, and the elite execute focused acquisitions in sectors with consistent demographic and technological tailwinds. Liquidity has always been the hurdle of the private market until lines of code, redefine the barrier. We must examine the mechanics of asset tokenization and decentralized finance, or DeFi. For generations, the biggest downside to owning a commercial skyscraper, a piece of fine art, or a private equity stake was that your capital remained locked. You couldn't sell a fraction of a building to fund a new venture. In 2026, blockchain technology solves the liquidity problem. The industry has moved beyond the speculative hype of basic cryptocurrencies into the actual tokenization of hard, tangible assets. Another leading 2026 wealth management report emphasizes that tokenization is repricing cash and assets across the entire financial spectrum. Imagine owning a $10 million commercial high-rise in Singapore. In the past, selling that asset meant hiring brokers, waiting months for buyers, paying heavy transaction fees, and navigating complex legal hurdles. Today, that building converts into digital tokens on a secure, transparent blockchain. Each token represents a specific fraction of the property. If you need $500,000 in immediate liquidity, you don't need to refinance the mortgage or sell the entire building. You simply sell a fraction of your digital tokens on an exchange in seconds to a verified buyer on the other side of the planet. This is the essence of decentralized finance applied to the real world. It strips away the middlemen, the bankers, and the extended delays. It allows modern investors to build custom, diversified portfolios of global assets with the exact same ease as buying a share of a public stock. Data from analysts confirms that young high-net-worth investors view digital assets and tokenization as core components of a diversified portfolio, requesting their wealth managers integrate these systems. Wealth management firms are redesigning their platforms to offer friction-free access to these tokenized private markets. The elite utilize these embedded distribution systems to remain agile. They hold illiquid, high-yielding assets, but retain the power to liquidate specific fractions at a moment's notice. This architectural shift bridges the gap between the stability of physical assets and the speed of the digital economy. Mastering these institutional strategies is only half the equation. To break away from the retail mindset, you must understand how to construct the precise legal entities that shield this capital from liabilities, audits, and systemic changes. The exact blueprint for setting up an established offshore trust and an unlisted holding company network is laid out step by step in this video right here on the screen. Click on it now, and I'll see you there.